Welcome everybody to SelectPath's fourth installment of Benefits Bootcamp. My name is Gord Hart and I will be the moderator of today's podcast. The subject is Underwriting 101. For the agenda, we're going to cover the basics, risk tolerance, funding methods, and renewal rating. It is important to note that the opinions expressed in this podcast reflect those of the presenter and do not necessarily reflect those of SelectPath Benefits and Financial. The basics of underwriting start with some definitions, and these definitions would include risk, which means the exposure to the chance of financial loss, insurance, the transfer of risk from the policy holder to the provider, pooling, which is the risk-sharing arrangement whereby the provider assumes all liability for claims covered through the pooling arrangement, and funding, the method by which an employer pays the claims at the provider's expense. Risk is present in many forms. This may be the number of members covered under the plan, the demographics of those members, the industry and occupation of the members, the design of the plan, the frequency and amount of the average claim, the sharing of premiums between the policyholder and the members and pricing stability, who is responsible for the deficit, and disputed or litigated claims. When speaking about the premiums and how these expenses are applied, think of a pie chart where the claims typically represent 75% of the costs. Reserves typically represent 4% of the costs. Administration expenses, which typically range from 8 to 14%. Commissions, which can range from 4% to 10%. Provincial taxes, and this would include premium taxes as well as retail sales taxes, where applicable. Interest, which would be a small charge levied by the insurer for carrying the premium risk. And then other expenses, which would include risk charges or profit charges of the provider. When we look at the expenses of a plan, there are some basic factors in review. The first is something called the loss ratio, and that is the ratio of the claims and expenses to the premiums paid. The insurance companies look at the profitability of the account on the target loss ratio, and that is the expected claims divided by the premiums. Actual loss ratios can be shown as paid claims or incurred claims, the difference of those two being any adjustment to the reserve. Reserves are sums set aside for future commitments. These reserves could include disabled life reserves, where the insurance company expects to carry the risk while not carrying premium, waiver of premium reserves, incurred but not yet reported reserves. And these incurred but not yet reported reserves, or IBNR for short, are often a percentage of premium, and really accounting for the lag between when a claim is incurred by a claimant and when it's submitted to be paid to the provider. After a plan sponsor has decided on the plan design, there are additional considerations. One is the policyholder's risk tolerance. Another is the funding approach, and the last being the premium rate determination. A policyholder's risk tolerance is really the level of exposure to a claim that the employer wishes to take in the event of a claim or claims. It can range from no risk, limited just to the premiums payable, to full risk, where the provider only adjudicates the claim and passes on the full cost of the claim and administration fees to the plan sponsor. As the risk increases to the policyholder, the insurance charges of the provider typically reduce. Other risk tolerance issues are cash flow. For example, can a policyholder financially manage large swings in claims from period to period, whether it is monthly or year to year? The budget process. Does the plan sponsor want to have a predictable monthly cost? And the sharing of the premium. Is that premium shared across all departments, all divisions, and with employees? When we break the risk tolerance down by type of benefit, it can vary greatly. For example, accidental death and dismemberment is a high risk for a small employer, small being 1 to 100 members, while for a mega employer, meaning 1,001 employees and more, it is still a high risk because of the amount being insured and the frequency or lumpiness of the claim. Life insurance also can be a high risk to a small employer and can move to a medium risk for a mega employer. Long-term disability, again, can be a high risk for a small employer. One claim could overcome the premiums being charged. Whereas for a mega employer, it is a medium risk because of the volumes of coverage and potentially premiums being set aside. Short-term disability or weekly indemnity can also be a high risk for a small employer. Just like long-term disability, one claim or two claims could easily eat up all premiums being charged. Whereas for a mega employer, typically it's a very low risk because of the frequency of claims across 1,000 plus employees. Health premiums can be a large risk for a small employer because of the potential for catastrophic drug claims or hospitalization or durable medical equipment. Whereas for a mega employer, it's relatively low risk because the spread of that risk across a large workforce. Dental can be a medium risk for a small employer, typically because most of the benefits include maximums. And let's face it, if the employee has a catastrophic claim of all of their teeth being extracted, there isn't a whole lot of claims beyond that. For large mega employers, the risk is very low. Again, average claims across a large group of employees makes it a low risk. So thinking of the size of the employer, or plan sponsor if you will, the risk can vary depending on line of benefit to be insured. For the most part, infrequent lumpy claims like life and disability can be higher risk across all sizes of employers, whereas more frequent prepaid expenses, if you will, on health and dental and sometimes short-term disability and weekly indemnity can be low risk for large employers, but can still create some high to medium risk for small employers. As the employers scale, they must continue to look at this risk to determine whether they want to pass that on to the provider or keep it or take it themselves. In terms of risk tolerance, employers take on additional risk in order to reduce costs on a long-term basis, potentially if the claims are predictable. They may want to take on more risk to get more flexibility in plan design, in pricing, claims adjudication, and underwriting. If the plan sponsor employer is taking the risk, they have more decision-making in the process of managing their employee benefits. But watch out, with that risk comes liability. So you must look at all of the risks associated with the different styles of funding your benefit plan. When considering risk tolerance, full clarity is required. What that means is the policyholder's risk tolerance, the benefit plan exposure, and the policyholder's motivation and understanding of the risks. All of these factors generate a funding methodology recommendation, meaning how much risk tolerance and risk can be absorbed by the employer and what are the costs associated with taking on or passing off that risk. One of the funding methodologies is financial accounting or refund accounting. This refers to sharing the financial results at the end of the financial period. If there's no sharing of results, the underwriter is fully insured or non-refund. If there is sharing, the underwriter is refund or retention accounting or administrative services only, meaning self-insured. Non-pooled arrangements require a separate agreement outside the group contract, which outlines the various charges which will apply. Under the self-funding model, those charges typically are higher than they are under the fully insured model because of the cross-funding of risk. Digging deeper into funding methodology, non-refund accounting or fully insured means that all of the risk remains entirely with the insurer. The policyholder has no access to surplus funds nor responsibility for any deficits that are accrued. Of course, this then means there's a higher risk charge built into the expenses, and typically, this funding methodology is appropriate for low-risk tolerant policyholders and or high-risk benefits, as well as smaller employers. The next option is refund or retention accounting. In this structure, the policyholder shares in planned surplus and is responsible to pay deficits up to agreed upon amounts. The risk ultimately remains with the provider, but there is an annual accounting of the plan. It also includes pooling arrangements inside of the health benefit. There is a lower risk charge built into expenses because of the obligation and access to the deficit and surplus. And it is a more appropriate funding model for medium risk tolerance policyholders and typically medium to large policyholders. That would be 101, potentially up to 1,000 employees. Administrative services only is another funding method, and it is a self-funded plan. That means the policyholder hires the provider to adjudicate claims. The pricing for this can be based on budgeted rates or a deposit float if paying in advance, or can be billed in arrears, which means there are no rates established, but there can be interest charges associated with carrying the claim costs. The policyholder bears the full risk and liability of all of the claims and claims litigation. And typically, there is a pooling arrangement inside the extended healthcare benefit. Pooling has changed dramatically since 2012. And what's changed is the introduction of EP3. Before 2012, a plan sponsor could expect to see a risk up to a threshold, and above that threshold, which would be the large amount pooling or stop loss, the insurance company would have an internal pool of risk to spread that cost across their book of business. The EP3, which is run by the CDIPC, or CDIPC for short, has three factors in pooling. First is the initial threshold, and that is the threshold in which a claimant would first become eligible for EP3 pooling. There would then be an ongoing threshold in which the claims would have to reach this threshold after the first year and ongoing to continue to be pooled. And then there's a maximum amount that the CDIPC pool will accept. Above the maximum amount, the risk moves back to the provider. In 2012, the initial threshold was set at $25,000. In 2016, the initial threshold was set at $32,500. But more importantly, the ongoing threshold was $65,000. The maximum coverage available to providers under the CDIPC program is $500,000. So realistically, in 2016, an insurer would accept the risk under $32,500 and over $500,000 for any single claimant. When EP3 was introduced, the participating providers agreed that all fully insured extended health care benefit policies had to have EP3 charges built in unless there was an annual deductible equal to or higher than $1,100 per single individual or $2,200 per family member, and or a series of annual and lifetime maximums that meet or exceed either the EP3 or industry pooling thresholds. Eligibility for EP3 depends on coverage in place as of June 7th, 2011. Additional pooling arrangements exist, and they usually include coverage under the extended health care, but may also include the life and long-term disability benefit. They can apply to any and all components. The annual review of claims and the removal of amounts in excess of the set limits are determined by the carrier. Large amount pooling, or stop loss if you will, is typically $12,500 upwards to $15,000 for small to medium groups. Aggregate pooling, which protects the plan sponsor against claims growing at a pace greater than a percentage of the prior year claims, typically is set around 125%. Other pooling includes first dollar out-of-province, out-of-country coverage. Plan sponsors need to be careful to understand all of these factors when reviewing their contracts because they do differ from provider to provider. So in summary, on funding methodology, the features that you need to consider are the risk, the detail on accounting, the limits of risk to the policyholder, the stop loss and pooling arrangements, the risk tolerance of the policyholder, and the benefit payment. On a non-free refund fully insured, the risk is passed to the insurer. There's no accounting statements. There typically is stop loss and pooling embedded in the pricing. It's favorable for low risk tolerance customers and for benefits that have unpredictable patterns. Refund accounting, or simplified refund, the risk is shared between the policyholder and the insurer. There is accounting, so you get to see the financial performance of the plan. There are some limits of risk to the policyholder. Typically, they include some pooling arrangements, stop loss. It is favorable for medium risk tolerant customers, and it is more favorable for moderately predictable claims. ASO or self-insurance, the risk is borne solely by the policyholder. There is complete disclosure and accounting. There are no limits to the policyholder unless a contract is established to pool some of that risk. There is access to stop loss and pooling arrangements. This type of underwriting method is favorable for high risk tolerant customers and is more favorable for highly predictable claims. Risk factors including the number of plan members, non-refund and insured has low risk. ASO or self-insurance has high risk. Plan design and flexibility typically is limited on refund or insured since the insurance company is carrying the risk. Whereas on self-insured or ASO, there's high flexibility since the policyholder owns all the risk. There's no legal risk to the policyholder on refund or insured plans. There is complete legal risk to the policyholder on ASO or self-insured. In terms of deficits and surpluses, there's no reporting on insured or non-refund accounting funding. On ASO or self-insured, deficits and surpluses are owned by the policyholder. Renewal pricing or renewal rating, the premium rate determination refers to the method of settling premium rates. be it pooled or prospectively rated. In prospectively rated, typically the rates are set by the insurance company utilizing their own internal guidelines established, reviewing the prior year's consumption patterns and projecting forward to the next year. So the process to set a renewal rate typically includes the provider establishing a premium rate based on past experience, plan expenses, and other factors, i.e., trend or inflation, for the upcoming period. The approach depends on the benefit, type of underwriting, and size of the group, and premium rates are usually established for a 12-month period. Life, accidental death and dismemberment, and long-term disability may be set for a longer initial period, but typically renew for a 12-month period after the first renewal. The factors the insurance company uses in establishing the renewal rates include the demographics of the group, so the age, the gender, the salary, the manual rates for the group, credibility factors applied to the experience, meaning how much of the claims experience is actually used to establish the rates and how much of it is pooled across the block of business of the insurer, the actual claims experience by benefit, the plan expenses or break-even target loss ratio, inflation or utilization factors, incurred but not yet reported reserve requirements, and waiver of premium and disabled life reserves. Under the pooled methodology for renewal rating, the initial and renewal rates are set by the insurance provider based on the plan member demographics and benefits insured. The rates are based on the provider's block of business for similar size policyholders and makeup of the group. Reports the premiums and claims experience for information purposes only to the policyholder. Demographics of the group, i.e. the age, the gender, the salary, represents the age and the volume distribution inside the group. The insurer is looking on how that has changed over the past year, as well as pricing variations for changes in the insurer, the economics in the environment as well. Manual rates for the group uses the insurance company's book or manual rates for each employee's age and gender. It also applies industry and location factors and is incorporated into the demographic information. Under a prospectively rated renewal methodology, the initial and renewal rates are based on the claims experience of the plan in whole or in part for future financial periods. The level of the credibility is based on the size of the group. The larger the group, the more credible. The provider reports the premium and claims experience as this is taken into consideration when establishing the renewal rates. The renewals typically exclude premium and claims based on the extended healthcare pooling level. Actual claims experience by benefit, typically the life and long-term disability, use the last 5 years. Weekly indemnity, typically use 2 to 3 years. And health and dental, typically the most recent year, or can use a weighting factor to include the last 2 or 3 years. The plan expenses or break-even target loss ratios include expenses associated with operating a particular benefit, including general administration, claims administration, pool charges, risk and or profit charges, premium taxes, commissions, printing charges, customer service charges, if applicable. The target loss ratio represents the break-even point for the account, i.e. the percentage of claims versus premiums needed for the plan to break even. The basic renewal calculation on a prospectively rated renewal has 5 steps, and these steps include a calculation of the paid premiums adjusted for changes. These changes could include a premium rate change or amendment during the insured period, paid claims plus the incurred but not yet reported reserves. The addition of the reserve to the paid claims make incurred claims. The incurred loss ratio, which is the incurred claims to adjusted premiums. The trended incurred loss ratio, which includes the incurred loss ratio multiplied by the trend factor on health and dental benefits only. And then the experience rated adjustment, which is the trended incurred loss ratio divided by the target loss ratio. Credibility factors can then be applied to the experience. And again, this is the proportion of a rating that's driven by actual claims experience. Really, the insurer is looking at how credible or believable the experience is compared to the insurance company's block. Credibility factors are based on the number of life years available. Life years is a unit of measurement, which typically is the number of lives multiplied by the number of years the policy has been in force. So for an organization with 500 plan members who have been insured for 5 years, that would be 2,500 life years. Health and dental benefits require relatively lower numbers of life years than life and disability because of the predictability of the claims. The longer the period, the better the indicator. The longer the period, the better the indicator of a pattern. Weightings are often applied when there's more than 1 year of experience to be considered. The weightings vary by insurance provider and can vary by type of benefit and can be applied over different periods, i.e. 2-year or 3-year period. The weightings change by benefit and likelihood of claims. For example, a 5-3-1 weighting, which is typically used by Great West Life, means that the current year increase is 5 times the use. The prior year's increase is 3 times the use, and the previous year's performance is 1 times the use. So you divide that sum by 9 for a weighted increase. Inflation or utilization factors, when used in renewal rating, are typically applicable to health and dental benefits, where cost and usage tend to increase year over year. Inflation on health and dental costs are significantly higher than the Consumer Price Index. Healthcare is a very small component of the CPI basket of goods. Trend or utilization factors differ by insurer. Generally, older employees have a higher likelihood of illness, which can result in higher claims. Guides like the dental fee guide increase annually. Changes in the legislation and the economy impact the claims. Most recently, OHIP Plus in Ontario. Incurred but not reported reserve requirements represent the estimated amounts the insurance providers need to set aside to pay for future claims that are incurred by one contract year but not reported and paid until the next contract year. Reserve factors vary by benefit and provider. For example, life insurance could be 8 to 12% of the premium. Long-term disability could be 40 to 60% of the premium based on the qualifying period. Weekly indemnity can be 15 to 25% of the premium based on the duration of coverage. Extended health care can be 5 to 8% of claims with a drug card and 15 to 30% of claims without a drug card. Dental can be 8 to 12% of claims. Of course, these factors vary by group size and or plan design. The impact of waiver of premium and disabled life reserves are represented by the estimated cost of the present value of future benefit payments for disabled employees. The waiver of premium relates to the future death claim of a currently disabled employee, and the disabled life reserve relates to the LTD benefit payments that are expected to be made for each claimant. Reserve amounts are based on the claimant's age at disability, gender, benefit amount, and expected duration of disability. At renewal, the providers will report on the aggregate reserve liability for all disabled employees as part of their rating and pricing. That ends our podcast. Hopefully you have found the Benefits Bootcamp useful information in understanding group insurance and how the risk and pricings are determined by the insurers. Reach out to us at SelectPath if you have any questions. Thank you and bye for now.